The International Accounting Standards Board is consulting on possible new accounting requirements for mergers and acquisitions of companies within a group. These transactions, which we call business combinations under common control, take place in many countries around the world. For example, a parent company might decide to merge some of its subsidiaries when preparing to sell these subsidiaries on a stock exchange. Or a listed company with a majority shareholder might acquire a business from another company controlled by the same shareholder. Accounting requirements for mergers and acquisitions are set out in our Standard on Business Combinations, IFRS 3. However, IFRS 3 does not apply to mergers and acquisitions of businesses within the same group. Because of this gap in IFRS standards, companies report these transactions in different ways. For example, some use what we call the acquisition method in IFRS 3. That involves measuring assets and liabilities received at their current market values or fair value. Other companies use some kind of book value method. That involves measuring assets and liabilities received at their existing book values, which often are based on historical cost. Very often, investors do not get good information about these transactions. This makes it difficult for them to understand the effect of these transactions and to compare companies that undertake similar transactions. The consultation paper sets out our preliminary views on how to fill this gap in IFRS standards. What we're aiming for is greater consistency in the reporting of these transactions and more transparent information for investors. Our initial thoughts are that business combinations under common control are not all the same. Different circumstances require different information. In other words, one size does not fit all. Instead, we are suggesting that the acquisition method in IFRS 3 should apply when the combination affects investors outside the group, such as minority shareholders in a listed companies. That would mean that these shareholders would receive similar information as they get on mergers and acquisitions between unrelated companies. In all other cases, such as a restructuring of wholly owned subsidiaries in a privately owned group, a clearly defined book value method should be used. Specifically, assets and liabilities would be measured at the existing book values in the books of the transferred company. We are seeking stakeholder input to help firm up our views on this topic. I encourage you to share your views with us by 1st September 2021.